We predicted that from the peak to the bottom, we would see a drop of 10 to 15%. Home prices fell 11%, which is within my predicted range. Currently, prices are down 3.4% from their peak. Now, let us show you the mortgage interest rates. This chart displays the 30-year fixed mortgage rate over the past year, sourced from Freddie Mac. It has remained relatively stable between 6 and 7% for quite some time. Now we want to show you a 3-year chart depicting the number of homes sold each month. Transaction volume is down 16.2% compared to the previous year. However, this is an improvement from April when it was down 25% and from January when it was down 33%. It's important to understand that home prices are influenced by supply and demand. The current situation reflects basic economics. To have a housing market crash, there would need to be more sellers than buyers, but that's not the case at the moment. Let's examine the supply side of the equation. There are currently 1.47 million homes listed for sale, down by 5.7% compared to the previous year. This 5-year chart clearly shows that the supply is still lower than pre-pandemic levels. Now let's focus on the percentage of homes sold above the list price. This 5-year chart reveals that in May, 37.5% of homes were sold above list price. Although it's higher than pre-pandemic levels, it's not as wild as it was in 2021 or 2022. However, seasonal factors should be taken into account when analyzing this data. If you're considering buying a home, it's important to keep in mind that more than 1 out of every 3 homes is selling for above list price. I'm not encouraging overpaying, but it's not uncommon in the current market. For sellers, it's essential to have a realistic expectation. The housing market is heating up again, but it's not as extreme as it was 12 to 24 months ago when 60% of homes were selling above priced list. Looking ahead, there are factors that can drive home prices up and others that can bring them down. The key question is which one will outweigh the other. The lock-in effect is still prevalent, with the majority of homeowners having mortgage interest rates under 5%. This makes them hesitant to sell and contributes to a shortage of inventory, thus keeping home prices elevated. Additionally, there is an ongoing systemic shortage of homes, which is expected to continue throughout the decade, although it should gradually improve over time. On the other hand, a deteriorating economy, as forecasted by the Federal Reserve, could exert downward pressure on home prices due to a potential recession and higher unemployment rates. Regarding predictions, mortgage interest rates are expected to decline gradually by the end of the year. The housing market is likely to remain a seller's market, but buying might gain slightly more bargaining power. Home prices will vary by region, with the West experiencing more instability compared to the East, while the Midwest and South are expected to have more stable prices. Various institutions have different predictions for home prices. Zillow forecasts a 3.5% increase. Morgan Stanley expects prices to remain flat, and Fannie Mae predicts a 1% decline. Some institutions even suggest a drop of 15 to 20%. Personally, we predicted a housing market slowdown, not a crash, and expected home prices to fall by 10 to 15% in this cycle. The current 3.4% drop from the peak does not qualify as a crash in my opinion, although we understand the impact it can have on individuals. It's important to acknowledge that the term housing market crash is subjective and can be interpreted differently by different individuals. Some may consider a 3.4% drop as a crash, while others may reserve a term for larger percentage declines, such as 20, 30, or 40%. However, it is crucial to note that the severity of 3.4% drop should not be discounted, as it can still have significant financial implications. for homeowners. Losing a percentage of that magnitude can be distressing for some. To consider the possibility of housing market crash, we need to assess the availability of sellers and inventory. Last year, approximately 6 million homes were sold, while currently there are only 1.4 million homes listed for sale. In comparison, during the 2010 recession, there were 2.9 million foreclosed homes dumped into the market, leading to a crash scenario. Foreclosure rates have seen a 14% increase year over year, but they are still nowhere near the levels witnessed in 2010. To reach the magnitude, foreclosures would need to rise by around 2,000%. This year, around 130,000 foreclosures are projected, far from the millions needed to trigger a housing market crash. Considering these factors, the question remains: where will the substantial influx of sellers and inventory come from to drive a housing market crash? While some indicators suggest potential downward pressure on home prices due to a recession and higher unemployment rates, the current data does not support an imminent crash. It is essential to interpret the available information accurately and not jump to extreme conclusions. As always, real estate predictions carry uncertainties, and the market dynamics can change over time. Monitoring ongoing trends, economic factors, and supply-demand dynamics will provide a clearer picture of the housing market's future direction. Let us know what you think in the comment section below. Like and subscribe for more interesting and helpful contents. See you in our next video.